AS10 Property, Plant and Equipment. Let's see the definition of PPE as per AS10. So those are intangible items held for use in the production or supply of goods and services, for rental to others, for administration purposes. It is expected to be used for more than one period, that is 12 months. So PPE are tangible items and it is held for use. Held for use for what basically? In production or supply of goods and services. It is held for use for the production or for the supply of goods and services, or for rental to others, or we can use it for administration purposes. And it is expected to be used for more than one period or 12 months. Only if these conditions are satisfied, it meets the definition of PPA. Now, there is another thing, bearer plants. What are they? Bearer plants are actually living plants that are used in the production or supply of agricultural produce. They are used in the production or supply of agricultural produce. For example, mango tree. Mango tree is a living plant, right? And it is used in the production or supply of agricultural produce. Used in the production or supply of what? Mangoes. And it is expected to bear produce for more than 12 months. It can produce more than 12 months. So bearer plants are actually living plants and it is used in the production or supply of agricultural produce and is expected to bear produce for more than 12 months. So AS10 will be applied to the bearer plants but not to the produce of the bearer plants. For example, in case of mango tree is a bearer plant and AS10 will apply to the mango tree. But mangoes are the produce of the bearer plant. For that the AS will not apply, but for bearer plant, the mango tree here, the AS10 will be applied. And then there is a note here. Bearer plant has remote likelihood of sales as agricultural produce. What does it mean? It means that the plant itself is not grown to be sold as produce, but rather to produce items that are sold as produce. It means that the plant, we are not producing the plant to be sold. We are not producing the plant to sell it. We are actually growing it so that it can produce items that can be sold. We are growing the mango tree not to cut the mango tree and sell it. We are growing the mango tree to produce mango that can be sold. So the plant is not grown itself to be sold, but rather it is used to generate or to produce items that can be sold. That's all about bearer plants. Now let's see what is the scope of AS10. AS10 excludes intangible assets and the assets taken on lease. What are intangible assets? Intangible assets are actually dealt in AS26 and assets taken on lease are considered in AS19. So all these items are not covered under, these assets are not covered in AS10. And also biological assets. Biological assets means what? Biological assets are living plants and animals. In case of living plants, AS10 will apply only if it meets the definition of PP. Otherwise, it doesn't apply. AS10 doesn't apply if definition of PP is not met. In case of living plants, living animals, and in case of plants, only bearer plants AS10 apply. Bearer plants AS10 will be applied. So, scope of the AS10, it excludes intangible assets, assets taken on lease and biological assets other than bearer plants. Now, how will we recognize PP? What are the recognition criteria for PP? If it is expected to generate future economic benefits and if the cost can be measured reliably, then we will recognize it as PPE. It has to generate future economic benefit and the cost can be measured reliably. Only then we will recognize it as PPE. Now, what are the measurement criteria for PPE? There is an initial measurement and a subsequent measurement. Initially we measure, that is initial measurement. How will we measure? Using the cost model. And then subsequently, after a later period, we will measure it, that is subsequent measurement, and it will be based on cost and revaluation model. Let's see. In case of initial measurement, we are dealing with different types of asset. There are 5 different types of asset. Let's see. Asset is first type. Asset is acquired by way of purchase or asset is self-constructed. So first we are learning about the asset that we purchase or we self-constructed or we construct. So that is dealt in the first portion. And next, asset acquired by way of exchange. By exchange, we acquire the asset. And third one is asset acquired by way of government grant. That will be dealt in AS12. And consolidated price. And then asset acquired as finance lease, AS 19, we will deal it in AS 19. For consolidated price, it is apportioned on the basis of respective fair value as on the date of acquisition. So basically, the assets are acquired by different means, and in this AS10 chapter, we will discuss about first two models: asset acquired by way of purchase or self-constructed, and asset acquired by way of exchange. So the first one is asset acquired by way of purchase or self-constructed. How will we calculate the cost of the asset when it is purchased? So there will be a purchase price, right? So to the purchase price, we will less the trade discount, and we will add the non-refundable taxes to it and all directly attributable expenses and cost of decommissioning, restoration and similar liabilities at present value. So we have to add the purchase price less the trade discount and all refundable taxes and directly attributable expenses and cost of decommissioning, restoration and similar liabilities. So what are directly attributable expenses? These are employee cost, site preparation cost, initial delivery and handling cost, installation and assembly cost, testing cost after deducting any income that generate from it. Then there is professional fees, then there is borrowing cost if any, if it is a qualifying asset. So all these costs when added up, we will get the cost of the asset when it is purchased. What are they? Purchase cost less trade discount plus non-refundable taxes plus all directly attributable expenses. What are they? Like employee costs, site preparation, initial delivery, handling costs, installation and assembly costs, testing costs, professional fees and borrowing costs, and also the cost of decommissioning, restoration and similar liabilities. But some costs are excluded from the cost of PP. What are they? Like the inauguration cost, advertising, promotional activities, staff training, administration, general overhead, cash discount. All these costs are excluded from the cost of PP because these things doesn't generate to future economic benefits. It is not increasing the efficiency of the asset and all. So these costs are expense of. These are excluded from the cost of PP. What are they? Inauguration cost, the cost of opening a new facility or a business. Then there is advertising cost, the cost of introducing a new product or service. Then promotional activities cost. Then staff training, when a cost of conducting the business in new location or area, there will be a staff training, right? Then there is administration and general overhead cost. Then cash discount. All these are excluded from cost of PP. Now what if the asset is self-constructed? If we are constructing the asset, in order to find the cost, we have to add the material, labor, the fixed or variable production overhead, and add the directly attributable expenses and subtract the directly attributable income. Then initial estimate of restoration cost and borrowing costs. Of all these then adding, we will get the cost of the asset. Now there are some other things. When there is a day-to-day servicing, will we capitalize it? Will we add it to the cost of PP? No, we will transfer it to the P&L since it is day-to-day servicing. We have to do that, right? Day-to-day servicing. We will not capitalize every day-to-day servicing. We will transfer it to the P&L. And then expenditure which increase the life or efficiency of the asset. If it increases the life or efficiency of the asset and it helps in generate future economic benefits, then we have to capitalize it. We have to add it to the cost of PP. Then replacement or inspection. So due to replacement or inspection, there can be changes in the value of asset. So how will we account for it? We have to write the written down value of the asset and add the cost of new part. The new part is replaced, right? We have to add the cost of new part and subtract the written down value of the old part. So we will account it in this way. How? The written down value of the asset plus cost of new part minus written down value of old part in case of replacement or inspection. So that's all about asset acquired by way of purchase or asset self-constructed. Next, asset acquired by way of exchange. If asset is acquired by way of exchange, it depends on whether the asset has any commercial substance and non-commercial substance. If the said asset has any commercial substance, then how will we account? We will debit the new asset and credit the old asset. We are exchanging assets, right? And the asset acquired has a commercial substance. What we will do? We will debit the new asset account debit to old asset account. And how will we find the value of the new asset? How will we calculate the value of the new asset? First, we will see whether the fair value of the asset given up is provided. If the fair value of the asset given up is given in the question, we will take it. If not, we will take the fair value of the asset acquired. If both these are not available, then we will take the written down value of the asset given up. So if the asset acquired by way of exchange has a commercial substance, to calculate the value of new asset, first we have to check whether the fair value of the asset is given up, then we will take it as the value of new asset. If it is not given, we will take the fair value of the asset acquired. If both these are not available, then we will take the written down value of the asset given up. Now, if the asset has no commercial substance, the new asset valuation will be how? We will take the written down value of the asset given up. If it has no commercial substance, we will take the written down value of the asset given up. Let's see illustration 6. Entity A exchanges land with a book value of 10 lakh for cash of 20 lakh and plant and machinery valued at 25 lakh. What will be the measurement cost of the asset received? So here we are exchanging the asset, right? Asset acquired by way of exchange. Does it have a commercial value? We have learned that when asset is acquired by way of exchange, there are two classifications, whether it has a commercial substance or no commercial substance. Here the transaction has a commercial substance. If the transaction has a commercial substance, how will we value the new asset? The new asset will be valued. First we have to see whether fair value of the asset given up is provided. So here the asset given up is land. Is it fair value provided in the question? The land has a book value of 10 lakh. The book value of the land is given, but the fair value of the land is not provided. So we can't take it as the value of new asset. If first one is not given, we will move on to the fair value of the asset acquired. If the fair value of the asset acquired is provided, yes, right, the asset acquired is cash and machine, and its value is given as 20 lakh and 25 lakh. Since it is not mentioned, we will take the plant and machinery valued at 25 lakh as the fair value of plant and machinery. So the fair value of asset acquired is given. So we will value the new asset at this value. We have seen the journal entry, right? New asset account debit to old asset. What is the new asset account? New asset here, cash account and plant and machinery. So we will debit the cash and plant and machinery and credit it to what? Old asset is land, and the balancing is given to profit on the sale of land. So cash is what? 20 lakh and plant and machinery is 25 lakh. To land at rupees 10 lakh and profit on the sale of the land, balancing figure goes to 35 lakh. Let's move on to illustration 7. Entity A exchanges car X with a book value of 13 lakh and a fair value of 13 lakh 25,000 for cash of 15,000 and car Y which has a fair value of 13 lakh 10,000. So it is exchanging car X that has a book value of 13 lakh and a fair value of what? 13 lakh 25,000, right? So exchanging it with what? Cash of 15,000 and car of what? 13 lakh 10,000 fair value, right? The transaction lacks any commercial substance. Here the transaction lacks commercial substance as the company cash flows are not expected to change as a result of exchange. It's in the same position as it was before. How will we measure the cost of the asset received? So when the transaction has no commercial substance, then we will value the asset, new asset. How? We will value the new asset on the written down value of the asset given up. So what is the journal entry? New asset account debit to old asset, right? So the new asset here is cash and car Y. So cash or bank account debit to car Y account debit to, we are exchanging it with what? Car to car X account. That is our old asset. New asset account debit to old asset. And how will we value the new asset? The new asset will be valued on the written down value of the asset given up. Written down value of the asset given up is what? The asset given up is car X. So car X will be valued at its written down value or the book value provided here. What is it? 13 lakh. We will not look at the fair value. We will take the book value 13 lakh. Car X, they take it as 13 lakh. And cash or bank is how much? It is 15,000, and the remaining balance figure goes to car Y account.